All right, good morning. Today is Wednesday, June 15th, 2022. Welcome to this month's Capital Markets Update and Outlook call. I know some people are still filtering in here right now, so we'll give that a minute for that to happen here. As we wait for people to filter in here, just a quick reminder today, we're going to hear from our Chief Investment Officer, Tom Fox. Tom's going to review where we are in the markets and give you his outlook for the rest of 2022. Ultimately, this is kind of your opportunity to look over our shoulder, get an idea of what we're seeing. So I encourage you, if you have any questions, put them in the chat box and review them at the end. And I am just seeing, I'm not sure if my video is working, so hopefully everybody can hear me. Put in the chat box if you would. If you can hear me okay, can you go ahead and just in the chat box say, yep, I can hear you just fine, Eric. All right, great. Thanks so much. I appreciate that. All right, we will go ahead and continue. All right, so if you are joining us for the first time, my name is Eric Hagen. I am president of Capital Consulting Group, or CCG. CCG consists of myself, of Tom Fox, as I mentioned, of financial advisors Dan Oshman and Rana Grant. If you are here as a guest of them today, a very special warm welcome to you. Thank you for joining us. Thank you for taking a few minutes out of your time here today. And then, of course, our client support, John Knudsen and Marilyn Westmark. Together, we steward long-term relationships with our clients and work only for our clients. We can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. To learn more about this, after today's message, you can go to clearfinancialfuture.com and watch a short 2-minute video on exactly how that works. And we also give our clients' life savings the attention it deserves through our Smart Mix portfolio solution. Smart Mix is our personalized portfolio solution for individual investors. Well, whether you have $25,000 or $25 million, Smart Mix is our process for helping you get and stay invested right. To learn more about this and to see how we're doing, you can visit smartmixportfolios.com. We spend a lot of time on financial education. Most recently, I hosted these workshops. We had one titled Life After Work, How to Create a Good Life in Retirement. If you are nearing retirement or recently retired, this would be a great workshop to go and check out. I also did 2 workshops on legacy planning, both 6 steps to legacy planning for the generations, and then how to plan, communicate, and execute the smooth transfer of assets and values from one generation to the next. All of these past workshops are now available for your viewing at your convenience on our website. So the recordings are there. So I invite you to go and have a look at those if those would be of value to you. Looking ahead, we've got a couple of cybersecurity workshops. We always want you to be protected. We have both hack-proof your smartphone, 8 steps for hack-proofing your smartphone. And then we also have later on this month, we have 1 hour to savvy cybersecurity. So again, after Tom's message here today, go to our website, go to the events page, have a look, and RSVP for anything that looks to be of value to you, and you'll get that reminder email as the event approaches. And then looking out to next month in July, we will have our next capital markets update and outlook call as we're having today, except we will be live at Oak Ridge Country Club for a special halftime report luncheon. We will be halfway through the year, so this will be a great time to review the first half and look forward to the second half of the year. Registration is now open, so when we're done here today, give Marilyn here at the office a call or visit our website to make your reservations. The formal presentation will start at 11 a.m. with lunch to follow. And then lastly, in August, for those of you who are existing clients, please save the date for the evening of August 25th. After 2 years off due to COVID, we are excited to be back on Lake Minnetonka for our annual client appreciation event. I cannot tell you how much we are all looking forward to this. So mark your calendar, save the date, and watch for a more formal invitation. With that, I am going to turn it over to Tom. Again, Tom is our Chief Investment Officer. He spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. Tom has over 35 years experience building investment strategies. He has an impressive long resume. As always, I'm very excited to have Tom, you here today. And for all of you listening in, as you're listening to Tom, please feel free to ask any questions you have whatsoever. Just put them in the chat box. I'll be watching that chat box and I will bring them up to Tom for you. So with that, I will turn it over to you, Tom. Thanks so much for your time here today.
Thank you, Eric. Hello, everybody. Good morning. So we have a lot to talk about this today, and much is happening in the markets. And today is a big day because the Fed's going to make some decisions this afternoon around 1 o'clock our time. And so all the markets are looking to that meeting with Chairman Powell to see what direction the Fed is going to go. So I wanted to start off and look at our last month outlook that we did about a month ago and just point out some things. And first of all, I want to just point out that we had at the end of 2021 in December, we said that there was going to be a correction in the stock market in the first half. And what we saw coming was it was going to be a rough first half, and then the second half would be much better. And that we haven't changed in terms of our outlook. We think the first half has been rough. It has been rough, but we also think the second half will be much better. Now, last month we said, and I've highlighted in the red in the text, it says, but a washout may be here or soon coming. And we didn't, the market started rallying right after that, and we had a nice rally in the stock market, but it ended up, we are now gone into over the line into a bear market. And we said that the stock market lows may be ahead of us. And what's going on is the Fed may go too far. There's a lot of fear of that and a possible recession. Now, it's not our view that we're going to enter a recession. It still is not our view. And we're going to go through some slides. We'll show you why we are saying that. Now, also, we said last month, be patient. This correction is taking time to work out. And now we've got to kind of put correction / bear market, because we did go over 20%. And we're going to look at why in the next two charts. Now, this is the inflation each month by each bar. And if you look to the upper right-hand corner, you'll see that the last three bars, that we hit a peak in April, but look at what happened in May. The inflation rate dropped somewhat, 0.2%. But this last month, and this is what kicked off the bear market, going over 20% down from its high, it went back up. Now, we were not expecting that. We were expecting that the CPI would continue downward, but instead it bounced up slightly higher than it was before. Well, if you look at the next chart, you'll see what happened to the stock market. Now, we were in a correction phase, and what is a correction? It's -10 to -19.99. Well, we just edged over on that inflation report. Now, this morning, the markets are rallying ahead of the Fed announcement, which is interesting. The S&P is almost up 1.5%. So we'll see where it ends up. We might be back in the correction area by the end of the day, or it could go the other way. But what we do not believe is going to happen is that we are going to enter a recession. So we think this bear market is a non-recessionary market, and we'll show you why later on in our presentation. Now, I'm going to give the next two charts are interesting because I put together why you should not buy the dip. And I'll just say this. I think that if you have cash or you're coming into investments, I would probably wait a little bit, sometime towards the end of June before going in. But I have a list here why you shouldn't even buy then. Number one is that inflation may continue to remain high. That's a possibility. Now, we don't see that. Well, we think it's going to start coming down. Even today, the retail sales dropped off, and it was mainly because of used cars came down in pricing. And right now, the sales of used cars and new cars has dropped significantly. And we think that's going to cause a lower inflation rate. We think that the uptick this last month was just an anomaly, and we think it's going to start coming down from here on out. Now we were a month early on that, and that's what caused the market to go into a bear market. But we still think our data shows that the inflation rate is going to come down. Now the risk of Fed over tightening is increasing. To fight inflation, many investors, even very smart investors, are expecting the Fed to have to over tighten. In other words, bring us into a recession, and now that's increasing in probability. We again don't think that the Fed's going to cause a recession, and there's a number of reasons for that, which we'll go through. Now, the other reason is valuations have not come down enough relative to past bear markets. If you look at how far the PE ratio has gone on other bear markets, it's gone much lower. And there's reasons for it potentially to get cheaper, and that is that rates will probably keep rising, and they may start to impact earnings, corporate earnings. They haven't yet. In fact, the analysts right now are still saying that we're going to have pretty robust earnings the rest of this year, but we'll have to see. The other thing is profit margins have started to roll over, although they're still historically high, and a lot of that profit margin starting to come down has to do with the cost of goods and then what they are buying things for to sell to you and I. So that is starting to come down. And then of course, the Russia-Ukraine war, no end in sight yet. We think this will be resolved by fall. That's our forecast. And the other thing is China's lockdown because of COVID. They have a zero tolerance for COVID, and they're locking down as they did now even Beijing. And so they've been locking down cities, and there's still not an end in that yet because they're fearful that there's going to be another outbreak, a large outbreak of COVID-19. So we'll see what happens. They're a big part, second largest economy in the world. So they have a big impact if they lock down these major cities, which produce a lot of goods. And that could cause some supply issues to continue. Now, we may be heading into recession. In fact, I would say that most market strategists believe we are. We're in perhaps the minority. We don't think it's going to happen yet, but right now we're going to show you a lot of data in just a few minutes. Now, that's the reason not to buy. Here, we're going to give you some reasons to buy this dip. That there are signs we're going to look at that inflation is rolling over soon. And we think it's going to used cars and new cars are just part of that. And much of the bad news is already priced in. 70% chance of a recession is already priced into the stock market. So we think that much of the damage that they're expecting is already in the price. So any surprise or any less bad news will cause this the stock market to go up probably in an amplified way. Another reason is unemployment is very low. This is not typical of recession. We're going to see some charts on this. When you go into a recession, typically unemployment is rising and it's very high. That's not the case right now. In fact, we're almost at an all-time low, very close to it. 3.6 unemployment, that is extremely low and not typical of a recession. The other is the economy is still strong. We're going to look at some data on that. Employment still looks very good. And we're still in expansion territory. And we're going to, on the ISM, we're going to look at that. So we don't see yet in fact, manufacturing did go up. We're going to look at a chart on that even recently as May. So the other thing is that families and companies have large savings. They have a lot of money to keep spending. Because of the pandemic, it caused households to save a lot of money. Corporations saved a lot of money. So that both families or households and corporations have a lot of cash to keep spending. And we think the service sector may carry the day. Now, the beginning, it was goods that were carrying the day and service sector was lagging. Now there seems to be a transition from the goods sector to the service sector as people begin to spend the money, especially in this summer. I was just on an airplane. My son got married this last weekend. And I can tell you this, on the way out, the plane was full. On the way back, the plane was full. The airports are full. People are traveling. So the other reason that you may want to buy in the dip or begin to invest is long-term investors buy on bad news. And we've had plenty of bad news. And I want you to know Warren Buffett is buying because he is a long-term investor. So those are the reasons that you may want to buy in the dip. I wanted to show you both sides so you can make your own decision with Eric and the other advisors. But this is why the set of reasons that we could either buy or not buy today. So what's our outlook for the rest of the year in the second half? And remember, we said the second half was going to be much better than the first half. And one reason is we do believe supply chains will start to normalize. And even chip makers are saying that it's getting better. And that's been the primary problem with a lot of companies is they weren't able to get the chips, but that's getting better. And we think it's going to continue to get better as we go into the second half. And a lot of the supply chains are going to open up again. I know that even out in LA, where all these ships come in, bringing goods from overseas, that's getting much better. And it's even at the pre-pandemic level, where there isn't that many boats or ships out in the sea waiting to drop off their goods. So things are getting better in a lot of realms, and we think it's going to continue to get better. And we really think inflation's going to start to trend lower. We may have been a month early, but we think it's definitely going to go lower. There's a lot of reasons. We're going to look at some charts on that. And corporate earnings and revenues will remain decent. They're not going to be as robust as they are right now, but they're still going to be good. And so we still think corporations will find a way to keep their earnings up and their revenues will be decent. Now, what's going to drive this? The consumer spending keeps spending, mostly in the service sector, but based on what I'm talking to people, what I'm seeing out there is that the consumer is continuing to spend and they have money to do that. And even corporations do. And we do not believe, again, that the economy is going to go into recession. We think it's going to avoid a recession at this point. Now, down the road, there could be new data coming in, but based on what we see right now, we're not expecting a recession. Now, we've talked about this before, but during a midterm election, the stock market does not do well in the first half of the midterms. In fact, it averages about 1% in total return in the first half. In the second half, the average return in midterm years is over 13%. So we still haven't had our midterm election, but we're still in the first half, not until July. And that's when we think things are going to get better. Now, what are we saying about the year end for the S&P 500? I think originally my last call for this year was 5,100. I'm holding off on a number because we need more data to come in. But what we are saying, it's going to be higher than where we are. Now, it may take a while before recovering losses. You can see that how long it takes to recover 100% of your loss. In the dot-com blow up, it took 1,165 days to recover the losses from the high and then back in recovery. And then in the great financial crisis, when real estate was overbuilt and they were giving out mortgages just about anybody, that took 1,009 days to recover. In the COVID, in the pandemic, it only took 103 days to recover. And you can see in the first two recessions or bear markets, that how kind of flat the line was going down. But in the current one and the one we just had in 2020, you can see how fast the market dropped. It's almost straight down and then almost straight up. Now, if you look at our current one, it is similar. It is very fast compared to the dot-com and great financial crisis. You can see how fast the market has come down. Not as fast as the COVID drop, but it's getting there, got there very quickly. So what are we saying here? We think that we will have a V-turn when this market decides to turn around. We don't think it's going to be a flat long-term recovery. We think it's going to happen fast. It came down fast, and we believe it's going to go up fast. But it does take a while to recover all the losses. If you came in at the very top in the market, it's going to take quite a while to recover. But you have to look at the stock market over long periods, because you'll see that we come to new highs, and the market may go into a correction or over into a bear market, but it always recovers and goes to a higher high. And we expect that to happen as we move forward. Now, these charts I'm going to show you is that the economy is really showing it's remaining strong. And now in this chart, you can see prior to the pandemic that the average change in non-farm payrolls was about 191,000. And now look at, we're up at 488,000 in non-farm payroll increases. In fact, the last one was 390,000 jobs in May. That exceeded consensus. This is not a sign of a recession. And we think that the job market will continue to be strong. Now, can those numbers come down? They can, but we think that they're going to remain robust. Now, what about our unemployment rate? Remained low in May. In fact, it's the best rate since the pandemic. You can see prior to the pandemic what the unemployment rate was and where we are today. And we're just a hair above a half a century low in the unemployment. So this is a strong number. What it says that people are working, that means they're making money, and so they have money to spend. Now, what's coming against their ability to spend is the inflation rate, especially in gas and food, and that's a main staple among households. So we're going to see where those numbers will go to. And the Russian war and Ukraine, that's a big issue because that's where most of the grain comes out of, is Ukraine. So it's really causing, wheat is a major part of food. And so that is causing some issues. Now, I want you to really look closely at this chart, because this is the initial claims during the year preceding a recession. And you can see the black line. That's where we are today. This is the initial jobless claims preceding a recession. And you can see that where the other past recessions, where they happened, you can see how high the jobless claims were. Look where we are today. This is not showing a sign that a recession is at the door. This is saying that there isn't a recession in the cards at this moment. Now that could change, but you can see the past recessions, what the initial jobless claims were. But you can see today, the black line on the bottom definitely is much lower than historical recessions, preceding recessions. Now, the Institute for Supply Management, which shows the manufacturing and the service sector. Look at this. In May, we saw the manufacturing sector unexpectedly accelerate. If you look at the blue line, the last data point was in May, and anything above 50 means we're in expansion territory. So we're not even near, it's come down somewhat, but we just had a rise, a data point go up in the manufacturing sector. And so remember, it has to go below 50 before we see the expansion is ending. and we're not close to that yet. This tells us the economy is still strong. And here's one. This is May. Credit card spending was very strong. Dollar volume actually climbed 9.5%. So you can see this is Chase card data in aggregate, and you can see what's happening. People are spending. This is their credit card, and you can see that it's not going down, it's remaining high. Now it has a lot of volatility, but you can see the trend is clearly still up. So people are spending. This is not a sign of a recession is at the door. Now we're going to talk about the most important indicators. Is inflation going to go down? And we think it is. Now, former Fed chair just recently, Ben Bernanke, said that he thinks that they can still engineer a soft landing and avoid a recession. And if you look at it, all four components that are adding up to 2% of the CPI are all supply chain problems. What's that mean? It's transitory. And we just saw that used cars sales are slowing down, which means prices will start to go down, both in the used and new vehicle. We think furnishings and supplies are going to go down, and apparel is going to go down as the supply chains problems get resolved. So that total of those four, which are transitory, could reduce the CPI by 2%. And so we think that this is going to happen. And then we think it's this coming month or the next month, we'll start to see that data. Now, this is a chart showing used car prices and where it leads relative to the CPI. Now, this is moving the used car prices up 2 months, but you can see where the projection is that used car prices are going to head down, and it's already beginning to fall. But it takes the CPI data 2 months to get that into the number of the CPI. So this is moving the car prices up 2 months, and you can see how correlated it is with the CPI. So what this is telling us, and you can see the dotted portion is the projection, and based on today's retail numbers and used cars and new cars, we think that is probably pretty accurate, which means that this component of the CPI is going to be dropping very soon, and there's a 2-month lag. Also, mortgage applications are down 66%. And you can see what happens where the mortgage applications have gone down to a 22-year low. And you can see where the prices are. Now, the prices are still up, but we believe that because of the interest rates for mortgages, that house prices are going to come down. Now, I don't think it's going to come down what the red line is showing, but I think it will start to come down, which will drop that portion of inflation in housing and begin to bring down the number of the overall inflation. Now, what's holding up the prices is simply this: there's not a lot of inventory. And so when there's not a lot of inventory, and people probably will not be moving if they have a low rate, because if they move from house to house, they're going to get a much higher rate, over twice what they probably are paying right now. So that's going to come down. We don't know what level it's going to come down, but we think house prices are going to start to come down following the mortgage applications. Now, what's going on with COVID? COVID started spiking up again. And now we're starting to see the last 3 weeks, it's come down. Now, I mean, these are the last 3 days. We saw a significant drop in COVID. These are the new cases. So we think this new variant that's been spreading around. In fact, my son and his family have COVID right now. So it is going around. It's very contagious. But we are seeing some good numbers throughout the U.S. as things are coming down. And the cases in California, Texas, and Florida are still rising, but it's collapsing in New York and New Jersey. And so things are coming down on the East Coast. So we'll see what happens, but we are starting to see some good news there. Now, here are net hospitalizations. You can see the numbers are still going up, and the mortality or deaths is flattening. It's come down, but you can see both of them are nowhere near where they were before. So they're within the range of all-time lows. And so we don't think this is going to change unless some crazy variant comes. But we're seeing new cases beginning to drop, and we think it's going to remain low. And I would forecast that the net hospitalizations are going to begin to roll over too, and we're going to see even lower deaths. So that's the end of the presentation. What I think will happen here in the short term, the rest of June, it's going to be very volatile. And what's going to happen today with the market rallying, I'm just looking up, it's over 1% up today. We'll see where it goes. That's pretty amazing, since Fed Chairman Powell is going to give his direction of the Fed, where they're going. Are they going to go to 75 basis points instead of 50? Are they going to do 50 this time and 75 next time? We're going to get a handle on what their thinking is going forward. But obviously the markets, for some reason, are rallying today ahead of the Fed announcement. But at 1 o'clock today, Central Time, you're going to see this market go up or maybe even down. So we don't know yet. I wish Eric would allowed me to give this tomorrow after the Fed spoke, but he didn't. So we're going to have to see what happens.
We got to keep you on your toes, Tom.
Thank you, Eric.
Yeah, thank you very much, Tom. Appreciate that balanced view of what's going on in everything. I see a lot of you out there today, a lot of attention. So again, thank you for taking the time to be with us here today. I encourage you, if you have any questions, now is a great opportunity to drop a question in the chat box. We'd love to address that for you. I do have a couple that have come in, Tom, kind of over email the last few days, some common themes I've been hearing from people. One thing I've noticed is that a lot of the performance that we hear with the indexes and concerns that's what individual investors, particularly with our smart mix strategies, are experiencing, and somewhat of a surprise that we're not down nearly what the overall indexes are. Can you speak to that at all?
Yeah, so the indexes have a heavy weighting towards technology, Apple, Microsoft, and a few others, and they're down significantly. So the tech sector, which was a heavy weighting, has brought down the index, especially the NASDAQ, which is down or was down it's close to 30%. And of course, the S&P 500 just edged over that 20% mark, meaning a bear market. So what we have, smart mix isn't tied to the index. So we buy companies that we think have dominating, superior, forward-looking prospects relative to their peers. And so our companies, for example, we're down about 15.5% right now. And so we're not close to the bear market. And I was just looking, Eric, through our 8 strategies, and really we only have one strategy of the 8 that's in a bear market. And and it went into a bear market actually in the beginning of May. And it's been flipping back and forth between correction and bear market. And that's the thematic, which is a high growth strategy that's really looks out for the next 3 to 5 years. And it's a long-term strategy. It's high growth strategy, and it's disruptive technologies. And disruptive technologies have been hit hard last year and even this year. But their pricing, the prices of the stocks in the disruptive technology have gotten to the point where it's possible, and what I'm hearing from the portfolio managers of those particular ETFs is that they could see returns compounding 30 to 40% over the next 5 years. Now that's because they're coming from such a severe low. But if you look at all of our other strategies, whether it's durable dividend, which is down about 15 or so percent, wide moats down 15 or so percent, our tactical sector is only down 8.62. Our tactical style is down about 15 something as well. We have three strategies that are in the positive, which is really unusual for a year when bonds are down over 12%, the bond aggregate. If you're in bonds, you're down over 12%. If you're in corporates, you're even down more. So significant damage to the bond market. And our fixed alt is positive, over 1% positive. And then if you look at our super dividend, that's plus 2.68 for the year. And our recovery portfolio, where stocks that had been crushed during the pandemic, is up right now because they're recovering. It's up 11.67. So we have three strategies that have positive returns this year, which is amazing. So, and they're beating the benchmarks by a long ways. So the only strategy of the 8 strategies that we have is only the thematic, which we believe probably have the best prospects if you got long-term 3 to 5 years, and really where the pricing is now for disruptive technology, because they're going to have high growth going forward. They have great prospects, but the main core strategies are doing very well relative to the indexes, because we don't have to have a large overweighting towards technology or different sectors.
That's great. Thank you very much for that. And I'm reminded of one of the bullet points that you sent in your analysis for me yesterday regarding thematic. Point of encouragement is that NASDAQ 100, that index that we're comparing that to, often bottoms, I think you said 4 to 6 months ahead of S&P 500. That
is correct. And I was just listening to Kathy Wood, who manages the ARC fund, which is down over 50%. And that's what she was saying, that the ARC fund, they've narrowed their list of stocks to 35 stocks. And she was saying these are the highest conviction stocks. And she's expecting over the next 5 years, 40% annualized from where this rock bottom that we're at. So even though that particular strategy, we're not down 40%, it's down 28% as of right now. So it's down significantly less than the ARC, which is one component. So because we had diversification in it, but we think that's going for, if you have 5 years, 3 to 5 years, that will probably be the best performer. But during rough periods like we are in right now, it's a high beta strategy and it hasn't done very well. So it depends on how long-term of investor you are. But our core strategies are doing really well relative to the regular S&P 500 markets.
That's a very good reminder. And then a reminder for everyone, what makes Smart Mix smart is that we can, whether you're working with Dan or Rana or myself, we can customize your mix unique to you and your personal situation. So if you want a review of what your mix looks like, want to look at the performance of each of the different strategies in your mix, please don't hesitate to reach out. We'd love to review that with you. For many of you that don't have all of your money in the markets, traditionally, not with us, but traditionally, you'll take, 20, 30, 40, maybe 50% of your portfolio and put it into fixed, which is traditionally bonds. And as Tom mentioned, we have this fixed/alternative mix that we use for that safer side of the portfolio. And we've seen just a huge difference between that traditional approach with bonds, which I think you said are down over 12% right now on the whole, Tom?
Yes. Bonds bonds are down 12.65. So
versus our fixed alternative.
Yeah,
of
we're
up 1, right?
We're almost 14% variant, difference in return.
Right.
Which is, it's incredible. Now, let me just say
question,
this, Eric, we'll probably be moving back to fixed income. We're getting
That was my next question.
Yes.
I've had some people asking, what are you watching for? When is it time to be doing that? What are some of the signs that you're looking at?
Well, one of the things obviously is that the Fed is saying, here's the plan. This is where we're going to end our interest rate uh, increases. That's one thing definitely we're looking at. I think we're getting closer because if you look at the 10-year Treasury yields and the rest of the bond market, it was way ahead of the Fed's announcement of their interest. They've only hiked it 25 basis points so far, but you can see how high the 10-year Treasury and other yields have gone. So it's a discounting mechanism. So the bond market is way ahead of where it thinks the Fed's going. That's where the bond market is. This is where they think the Fed will go. Now, once the Fed starts in that, actually in reality, raising their rates, then then the market in the bond market will start to discount. Okay, we think they're going to end here. We're already up there, and now we think the rates are going to come down. Now we saw a little mini rally in bonds just recently, but I felt there was going to be another blowout in bonds, and I think we're getting closer to sort of the peak in yields, which would be a good time once we reach that point to get back into some bonds. And that's our plan. We're going to move out of some of our best performers, which have been the futures managers. They're up 12, 13% year to date. So we think it will be a good time to move out of those back into fixed income and so on. But remember, the bond market and the stock market are always discounting the future. And let me just say this about the stock market. If we head into a recession, which we don't think is going to happen at this point, but if we did, the market will discount the future. And when you get into more difficult economic times, it looks out farther to perhaps a year and a half. As things are going well, the discount of the future is maybe down to 6 months. So we think that even if we went in a recession and we find out, you never know when you're in recession until later. The data always comes out later. And so once you realize you're in a recession is when the stock market will discount and begin to rally. So it's really difficult to play the recession with the stock market because it discounts so far in the future, even if we did go into recession. Now, right now, our data is showing, and we're not there. If the data changes, then we may. And I would say this: if we actually went into recession, which we don't see now, we could drop 30% in the S&P 500. That's very possible. But we think this is a non-recessionary bear market, which means that the market will rally fairly fast.
Very good. Thank you. That's a good reminder. There's a difference between the economy and the stock market.
Yes.
Right. All right. I'm looking at the chat box. Oh, go ahead.
When you look at, again, when you're halfway through a recession, that's when the stocks start rallying, yes, anticipating coming out of a recession.
Yeah. All right. I am looking at the chat box. I don't see any additional questions. So we will wrap up today's call. If you do come up with anything later, please feel free to shoot me an email or Dan or Rana. We'd be more than happy to circle back with you more one-on-one. For those of you who are live today, I did put together kind of a summary of what Tom had to say. So I'll be shooting that out to you here in the next hour or two. Just a nice piece that you can refer back to. There's a lot of information on these calls. So it's a nice summary that you can show your friends how smart you are. Also, today's presentation was recorded, so I'll be getting this on the website here sometime later today. So if you do want to go back and look at particular charts or anything like that, you'll be able to have the opportunity to do that. If you want to stay in touch more often, you're invited to join me every Monday morning, 9 a.m. I do a short 3 to 5 minute kind of update summarizing what is actually happening in the markets the previous week, and then sometimes we'll talk about some nuggets of things that we're watching for. So that is done on Facebook and on YouTube. So if you're on either of those two platforms, go like, subscribe, follow, click the buttons, whatever they are at the different platforms to do that. And then when I'm done later on in the afternoon on Mondays, I do send out an email linking back to that, usually about 3 o'clock. So if you don't have time to join me live, you can get that email. You can subscribe to that email list at our website, of course, investwithccg.com. And then one last plug, reminder, I invite you all to join us for our next capital markets update and outlook call, July 13th, live at Oak Ridge Country Club for our halftime report with lunch to follow. So we'll have a presentation about 11 o'clock, and then we'll stick around, have lunch, answer questions more one-on-one. So registration again is now open. When I close up the call here, I will send you straight to that registration page. So I encourage you to take a minute to sign up for that. And if you have a friend or a guest that you'd like to bring with, please feel free to do so. We'd love to meet them and have the opportunity to share with them as well. So registration is now open. It's going to be a wonderful luncheon. We look forward to seeing you all there. With that, I will go ahead and close up our call. Tom, thank you again very much. Appreciate your time here today. And you guys all have a wonderful rest of your day. Thanks, everybody.